I'm going to look at a practical pricing problem in a rollover risk framework. And so my mentor, Mr. Mileta, asked me to basically just look at something on MultiCode. And I was thinking through what could be done and what would be an interesting angle to take. And so I thought about my master's dissertation that I've almost finished now. And it kind of links up together nicely. So I thought I would do a little bit of a blend here, and hopefully find it informative. So because it might get a bit technical, I thought I'd start off with an efficient markets hypothesis joke. So two financial engineers are walking down the street and they come across a 100 Rand note lying on the ground. And as the one guy reaches down to pick it up, the other says, "Don't bother. If it was a real 100 Rand note, someone would have already picked it up." So I imagine everyone's laughing behind their mute. Thank you for the positive feedback. So the context for today. So initially, I'm going to look at where every quant presentation starts at the GFC, and set the context as to why multi-curve is necessary. And then outline one of the consequences of the observations of the GFC, and that's a violation of spot forward parity. I'll then take a look at the MultiCode framework and some of the changes in yield curve bootstrapping, and then switch a little bit into a related, not identical, but very closely related phenomenon, which is the frequency basis, and the explanation for that, which is rollover risk. And then I'll look at pricing a credit default swap under this rollover risk framework, which is the basis of what I did for my dissertation. And then just go through the relevance of why the research is important and cool. So yeah, without further ado. So setting the scene, the global financial crisis of 2008. We have the default of Lehman Brothers, collapse of Bear Stearns, and suddenly we realize that LIBOR can no longer be used as a proxy for risk-free rates since we have interbank defaults. And yeah, so suddenly we realize that liquidity and credit risk that were previously considered negligible in the interbank market, we suddenly have to start thinking about this and rethink the appropriate rate for derivative valuations. So it changes the whole scope of how valuations are done. In addition, it also drove the need for the collateralization of OTC derivatives. Well, these valuations would now have to take the impact of collateral into account, and as we know, that would be done through the rate of remuneration defined in CSAs. So that's the scene. What happens? Well, one of the consequences is a violation of spot forward parity. So spot forward parity is the assumption upon which most of traditional yield curve bootstrapping is based. And we can illustrate it in the following way. If you consider two scenarios, suppose you borrow in a single step at a spot rate, applying from time 0 to time cap t. Let's say the rate is LIBOR, for instance. Then your obligation is to repay 1 plus LIBOR times the time at maturity. Then consider a second scenario. Suppose now, in the simplest case, we borrow instead over 2 steps. So this would entail borrowing at the spot until time delta, and then doing what we call rolling the borrowing over. In other words, whatever your accrued loan is, you just refinance that loan at that new point, at a new spot rate, obviously. Then it is also possible to enter into a FRA at time 0 to pay a fixed forward rate instead of the uncertain let's say, LIBOR spot rate at the time delta. So we have that the amount owed at maturity would then be 1 plus the LIBOR times the time up to time delta, multiplied by 1 plus the forward rate times by the next time period, also delta. And in the traditional scenario, under the assumption of no arbitrage, the value of both borrowings should be equal. In other words, you should be indifferent between entering into both these strategies. And you'll notice that if you rearrange this, it's the traditional forward rate formula in terms of spot rates. So, however, when we start to look at empirical evidence post-2008, we see that markets actually don't conform to this parity. And in particular, we see that the left-hand side is actually greater than the right-hand side, implying that longer borrowing is actually more expensive. And this is an observation I'll get back to in a bit. So what does this mean? Well, now we have to revisit our assumptions. So in response to the crisis, the classical pricing framework based on a single yield curve that was used to calculate forward rates and discount factors now has to be abandoned. And we now see a new modern pricing approach prevailing in the market. And that is the famed MultiCode Framework. So in short, the MultiCode Framework amounts to constructing a single discount curve and many forward curves. And basically, so looking at it, the discounting curve, these are the yield curves that are used to discount future cash flows. And the key here is that the curve must be constructed in such a way to reflect the cost of funding of the bank, for instance. And in particular, often an OIS-based curve is used to discount these cash flows. And this is where the term OIS discounting comes from. Why do we use that? Well, typically an OIS rate is what you would earn on the collateral posted. So by no arbitrage, it also needs to be the rate at which the future cash flows of the agreement are discounted. Yeah, and you also might see the term CSA discounting, which is a more broad term. So just referring to where the discounting of the derivative is then driven by the rules agreed in your CSA. The forward curves, on the other hand, these are the yield curves used to compute forward rates. And these curves must be constructed and selected according to the tenor and typology of the rate that is underlying the actual contract to be priced. So what that means is that we effectively have a forward curve for each tenor because that reflects the inherent risks in that tenor more accurately. So for instance, a swap floating leg that was indexed to, let's say, LIBOR 6-month would require a LIBOR 6-month forward curve. And that would be constructed from any instruments that reference LIBOR 6-month. So multiple forward rates reflect the fact that these forward rates, as I said, of different tenors don't have homogeneous levels of risk. So the longer your tenor, the deposit tenor, the greater the likelihood that the borrower may default, so increased credit risk. And in addition, there are different levels of liquidity associated with each tenor, which is fairly straightforward. So you may have, for instance, a 3-month Euribor rate being a lot more liquid than a 12-month. So this is effectively a 1-page summary of where the MultiCode Framework fits in. However, I'd like to take us back to the violation of spot forward parity. So this violation shows that longer borrowing is in fact more expensive. But how does this idea manifest in the swap market? Well, it does so through what's known as the frequency basis. And the frequency basis is the spread applied to one leg of a swap, a floating for floating swap, to where one of the floating legs of the swap reference different tenors, but they're in the same currency. So a classic example would be, say, 3-month or 6-month LIBOR swap, floating for floating. Many of you would have heard of the LIBOR-OIS spread, which widened post-2008. This can almost be viewed as an extreme case of the frequency basis. And this basis has become a really important feature of the interest rate markets since 2008. So because longer term borrowing is more expensive, when we consider a swap, you effectively have to pay a premium for the privilege of receiving the longer tenor leg of a swap, of this basis swap. Or if you want to think about it differently, you have to pay a premium to avoid having to roll over your borrowings on the shorter leg of the strategy, or of the swap rather. So if we look back to a pre-GFC understanding of interest rate swaps, the presence of a basis spread would point to an obvious arbitrage opportunity. So you would just lend at the longer tenor and borrow at the shorter tenor. So let's say we had a 6-month time period here. You would just lend at that longer tenor, borrow at the shorter tenor, and then roll borrowings over at that new spot rate. However, if we look at what actually happens, the basis spreads can't be explained by transaction costs alone, and therefore there must be a perceived new set of risks involved in the execution of the strategy. And the prime candidate for this is what's known as rollover risk. And this simply describes a risk that if you attempt to roll the borrowing over, this point here, the 3-month point, the borrower is unable to access those prevailing market rates. So it introduces risk here at the rollover point, and obviously if you were to increase the number of divisions here, the number of rolling over periods, you'd simply increase that risk. So basically, rollover risk can be broken down into two sources: downgrade risk and funding liquidity risk, or more broadly, credit risk and liquidity risk. So downgrade risk is the risk that creditors demand a greater credit spread than the prevailing market average. So that's a key point. It's not you don't have to look at it as like a systemic credit risk. It's that credit risk that is unique to you above the market average. So for instance, if you're a contributing bank to an LIBOR panel, let's say, and you drop out of that panel over the period of interest, you may no longer be able to access those prime interbank rates. That would be an example of credit downgrade risk. And then on the funding liquidity risk side, this is the risk that the market funding can only be obtained at an additional premium due to liquidity constraints. And this, for instance, could be seen during GFC market conditions, stressed market conditions. And this could occur even though your credit quality has remained the same relative to the market average. So they are distinct. And just an important caveat here, which it can be confusing sometimes. Rollover risk is distinct from conventional interest rate risk. Normal traditional interest rate risk you can actually hedge away, because you could take out a certain position in say a FRA or a swap, and you hedge away the risk of that interest rate moving in an adverse direction. However, you can't hedge away rollover risk. So you can't enter into a FRA just to take it back, you can't enter into a FRA to lock in the rate at which you borrow here. So once you get here to the 3-month tenor, is there a laser on here? Here we go. Once you get to the 3-month tenor, there's no guarantee that you'll be able to access the prevailing market rate, given the factors I just mentioned. And there's no instrument that you can agree to at time 0 to lock in that future borrowing. So that's why rollover risk is distinct. So if we look at Well, we could start to think about creating a model framework for this rollover risk, and thinking about how we go about then pricing instruments under the framework. So much of the literature on this topic thus far has been trying to model the frequency basis exogenously. So what this means is that you look at a set of basis spreads and you try and fit a model to that without really referencing the underlying reasons or the underlying drivers of that basis spread. So like I said, yeah, the approach does not allow for the extraction of information potentially relevant to risk management, and more specifically credit risk and liquidity risk. So the work of Alpheus et al. In 2020 was a huge contribution to the topic, because it focused on actually modeling the interest rate dynamics that then give rise to these basis spreads by the design of the model. In other words, endogenously modeling these spreads. And this allows for more meaningful inference on the relationships between liquidity and credit risk, as we'll get into later. Yeah, so this framework of Alpheus et al. Forms the basis of the pricing exercise that you're about to see. Cool, so getting to the actual meat of it, now we go ahead and try and price a credit default swap under this rollover risk framework. So just to set a little bit of background theory that's necessary for this model definition. Firstly, we have the concept of the short rate. That's an interest rate that applies over the next short period of time. And a mathematical abstraction of this rate is one that applies over the next instant. So you can let the limit of time tend to 0. Many stochastic models, as I'm sure everyone is aware, have been posited for the dynamics of the short rate, including the well-known Duffy model, characterized by mean reversion, and the Cox-Ingersoll-Ross model, which extended the ideas of Duffy and included a square root term to ensure that the short rate was positive, which is, of course, not that relevant an assumption anymore. So yeah, those are the basics. And then when we have a look at stochastic discounting, we can construct the notion of a bank account, which is a locally riskless investment that compounds continuously at the short rate RT. So we just have the exponential. And then from the bank account, we can construct a stochastic discount factor, which is a ratio of bank accounts. And the function of this is to discount a unit of currency from time cap t to time small t. So the absence of arbitrage in the market, if we assume no arbitrage, then this implies the existence of a risk neutral measure. And suppose we denote this Q in our scenario here. And then given the information known at time t, the filtration, the bond price, the zero coupon bond price, can therefore be specified as a conditional expectation under Q, under the measure Q of the stochastic discount factor. And then what we can do with this is then imply yields directly from these zero coupon bond prices. So don't worry too much about the filtrations or the measures. Just the point is that when we want to work out these zero coupon bond prices, we're going to take an expectation, a risk neutral expectation of the stochastic discount factor. Cool, so just a high level view of how to go about implementing this pricing. Firstly, we have to outline all model variables under the rollover risk framework. We then have to define stochastic dynamics for those model variables. We then theoretically derive all the pricing equations of a CDS under the framework. So considering the new risks. And then we're left with a set of expectations over here, and then we have to solve these, and we do so with what's known as the DPS methodology, and I'll get into that later. And then we repeat the process using Monte Carlo simulations for a point of comparison, and see how our results stack up. And then we go ahead and compare them and make inference. Cool, so firstly, outlining the model variables. So firstly, we have the relevant overnight rate, which could be Ionia, for instance. And this is an unsecured rate that is subject to credit risk. So we have the risk-free, i.e. the secured continuously compounded short rate as RT here. And then we add a average credit spread across the panel under consideration. So this would be, let's say, the average credit spread across 10 banks contributing to an IBOR rate. So it's almost like a sort of systemic credit spread that's not particular to you. So yeah, just notice the Q's there. So the Q is the loss fraction assuming default. So if default were to occur, what proportion would be lost? And don't worry too much about why it's being multiplied. It's a bit of a technical point. Then we also we can introduce rollover risk into the model by a factor pi, and this is defined as the sum of the idiosyncratic liquidity spread of the borrower, in other words, a unique liquidity spread of the particular borrower we consider, and the idiosyncratic credit spread of the borrower. So as we mentioned before, this represents rollover risk. It's just a sum of the particular liquidity risk and credit risk that applies to a particular borrower. So two important points follow from this. Firstly, the rate at which an arbitrary entity will roll their borrowing over is that overnight rate plus the rollover risk. And then secondly, the credit risk of an arbitrary entity is the panel credit risk plus their individual credit risk. So any unsecured lending will be discounted at this rate, which simplifies here, but that's not too important. So we've now defined the rollover risk variables, and we now have to go about specifying actual dynamics for these variables. So we can suppose that all three of these processes, the overnight rate, the idiosyncratic credit spread, and the idiosyncratic liquidity spread, are driven by CIR processes, CIR process dynamics rather. So actually what we have, the specification is a linear combination of different CIR processes. So each X here is an individual CIR process, and they're independent as well. So there's a very good reason why it's specified this way, which I'll get to, but the point is we settled on the sum here, D, being 3. So effectively what we have is each of these variables is a linear combination of 3 independent CIR processes. And they're linked together because these are the same, we're using the same CIR processes in each of these variables. And that's the point I was referring to, where we're now starting to actually link the term structure of these together, as opposed to sort of exogenously modeling it at a broad level. So we've specified the dynamics now. So now we look at deriving actual pricing equations in this new framework for a CDS. So just as a reminder, a CDS is a credit derivative between two parties that effectively act as an insurance contract on the underlying bond. So the buyer would come and make what can effectively be viewed as insurance payments, periodic spreads to the seller until the CDS terminal time or until the default time, whichever one happens sooner. On the other hand, the seller of the CDS protection will make a protection payment to compensate for the losses experienced by the buyer, provided that default happens before the terminal time. And just an important point here, that CDSs are typically quoted on this spread, which is a typically a percentage of the notional amount, such that it sets the value of the payment leg equal to the value of the protection leg if it's fairly priced. So when we're looking at it now, to start off, as I just mentioned, the protection leg of the CDS pays out in the event of default occurring before the terminal time of the contract. And suppose we denote that default time tau. And we've just alluded to the default intensity under RollOver Risk framework being this. So the total credit risk that we were talking about. Then we utilize a well-known result, which is extremely useful for the pricing exercise, that links an indicator of a default time to the credit risk or to the credit default intensity. So yeah, and this will prove really important in the derivation. So I'm just going to look at the protection leg in the interest of time, because there are also two payment legs which you have a similar process for, but this sort of illustrates the examples and the ideas that you need. So the present value of the protection leg is what you see here. And note that the reason it is this is because firstly, this Q is the loss fraction on default. So only a proportion of the total market value of the underlying will be paid out if it does default, this proportion here. And then secondly, collateralized payments must be discounted at the overnight rate, as we've alluded to earlier, which is this RC in our framework. So here we have our stochastic discount factor. And then the indicator follows because it will only be paid out if the default time is smaller than the terminal time. So just as you would under a non-stochastic model where we're considering a CDS leg paying out protection, this is just effectively the stochastic version of it under our framework that we defined. So it's quite a long derivation, quite a tricky derivation, but I'll just sort of highlight it quickly. So here's our statement from earlier, and basically what you do is you disintegrate this indicator function, and you let m tend to infinity, and you sum up just small increments of this indicator function. And then you can split that indicator function into a difference. And then because we split that into the difference, we can use the result that I just alluded to, this one here, because we have a single indicator function. We can then split these and it becomes those exponentials. And then using the mean value theorem, we can also simplify it, and we end up with a statement of this form. So we have an integral of an expectation where we have our model variables that we defined originally, and we need to find some way to evaluate this expectation. And that's where this new methodology comes in. So just a point that we repeat the process then for the two payment legs, and then the fair CDS spread can be found as the protection leg over the two payment legs, the sum of them. So now we have to try and solve those expectations. We use what's called the Duffy Singleton methodology, which is a paper they wrote in 2000. And it gives us closed form solutions to certain useful expectations of stochastic processes. And it provides solutions in the form of a set of ODEs. And that looks like this. So for example, an explicit solution to this kind of expectation is given by this statement here. And much of the challenge actually lies in specifying this R, the U, for instance, to match the expectation that we have in our pricing formula. So that was actually a lot of the challenge of this exercise. And then once you've specified them appropriately to match up with what we have, then you can go ahead and solve these ODEs, which are outlined here. And thankfully, that can be done using the ODE45 function in MATLAB. So once we've worked out those expectations, then we can obviously calculate a spread directly from that. So we've priced our CDS. We then go about repeating the same process using Monte Carlo simulation, where we actually simulate those original CIR processes from scratch using Monte Carlo methods rather. And we utilize what's known as a transition density approach because there's no explicit solution to a CIR stochastic differential, so we have to use this approach. And we simulated 10,000 paths for each of these rollover risk variables, and then computed the estimates for each of the CDS legs. So to compare the results, here we have the payment legs, the protection leg, and then the inferred CDS spread. And as you can see, the pricing of the Duffy et al. Methodology is accurate to about the 6th decimal, I think. And the main takeaway here is that it produces accurate prices, but in a fraction of the time that it takes to produce the same prices via simulation. And that's the main benefit of this entire exercise, because Monte Carlo is extremely computationally intensive, and the more accurate you want to make it, obviously that increases. Whereas Duffy is just a single calculation. So yeah, so why is this research relevant? Well, two main reasons, but firstly, as I just mentioned, computational efficiency. So for many practical applications, and you could think of, let's say, a bank having to reprice their instruments on a daily basis. And the state variables and the model parameters are changing all the time. So whenever you want to adjust even something slight in your model formulation, you'd have to rerun that entire simulation if you used Monte Carlo simulations. On the other hand, if you use Duffy pan-singleton and you define your stochastic processes like we did in that linear form, then what you're only running a single calculation, even if you change a state variable. There's no simulation that has to be done because we just had a direct explicit solution. So it's a really powerful methodology, particularly when you're working at scale and pricing at scale. Secondly, is the risk insight. It's a bit of a hard one to explain, but basically, if you look closely at the pricing methodology or the model variables that we defined, and you see the resulting equations in the CDS, the idiosyncratic liquidity spread actually doesn't factor into the calculations. It gets cancelled out. So that means in the CDS, we only have the idiosyncratic credit spread as a factor, which makes sense. But that means that we can actually explicitly work out the contribution of that credit spread to the rollover risk, because it's the only part of the rollover risk in that case. But if we were to price, let's say, an interest rate swap under the same methodology, the interest rate swap also includes the liquidity risk. So if we can price the CDS effectively, basically it means that we can quantify both the liquidity risk and the credit risk and separate the effect of the two. And this really helps us understand the liquidity risk and the credit risk and the interplay between the two of the underlying entity being modeled. So it's really about the insight into the risks facing the certain creditor or the certain reference entity. And yeah, as I mentioned earlier, the existing research, when you're trying to exogenously model that, it doesn't give you the space to have this kind of insight, which can be really valuable. So yeah, that is it. I know that was a lot of technical stuff in a very short space of time, but does anybody have any questions?